Hi guys, so there's been a lot of talk recently about this article that was published by the NRLA about what makes a landlord. If you've incorporated your property or you are using a limited company structure for owning assets, does that then imply that you're going to be investigated by the HMRC? In a nutshell, this is what the NRLA kind of put out. In my opinion, a bit more of a scaremongering, not scaremongering. I don't think, I have huge respect for the NRLA, by the way. I think they are doing a great job as a kind of a landlord representative to the politicians and everything else. So I think here it was misguided. I think the way they kind of framed the article caused a lot of angst amongst landlords. In a nutshell, what the article claimed was, well, HMRC is going after landlords who are using limited company structure to hold assets, and if they can't prove that they're owning or they're working within that company structure, they are going to be, I guess, fined, or their company or their tax will be at jeopardy, and meaning that they'll have to pay more tax. So let's be clear what the situation is. So if you are currently owning properties in a limited company and you're buying properties within the limited company structure, and that's how you own your properties and you're running your property business in that structure, whether it's you running it, whether it's you working on with your property managers or working with other agents to manage your property. If you buy and hold those properties in that structure, currently that's the structure to do it, because otherwise you are liable for much more tax if you're owning it in your personal name. So if you bought the property today in your personal name, you will have to pay tax on the gross rent, and then you get a rebate of 20%. If you're a high taxpayer, you end up at a much more disadvantage. If you end up selling it, your capital gains, you're of course liable for capital gains at, I think it's 25 or 28% at the moment. So owning property under personal name, quite frankly, right now, is nowadays, since Section 24 in 2017, is misguided, quite frankly, foolish. So what is Section 24? Just if people don't know, Section 24 was a law that was introduced by George Osborne, the then Chancellor of the Exchequer, to basically dissuade people, penalise them financially and via tax to not own properties as asset. And quite frankly, if I'm being truthful, it's to do with stopping the average working class person to do it. That's why the Tories introduced it, and I think that's why they wanted, or they don't want, no more people like you and I to own assets like properties, and also to pass it on to our next generation. Because quite frankly, capitalism works in this way, where the capital owners want to still remain the capital owners, and the workers, people like you and I, working class people, they still want us to be working class people. And I think that's why, I know it's a given when you read between the lines. That's why Section 24 was introduced in 2017 to stop people who own properties in their own name, to basically stop them in their tracks by increasing the tax that they pay. Now, why do I say that? It's because at no point in any business, if you are taking a loan, a commercial loan, in our way, a mortgage, to buy a property, in our way, it's a business that you're funding to then rent it out. In no other business sector can you not deduct that interest only, or the mortgage payment or the loan payment before tax. And they've changed that to say if you own a property in your personal name, you have to pay tax at your marginal rate. If you're a 40% taxpayer, you add the income that you make on the buy-to-let on top of your salary, and then you pay tax on that total income, and you get a bit of rebate around marginal rate of tax, which is 20%. But in effect, don't worry about the formulas here. It is the case that they do not want you and I, as working class people, to own assets. What they do want is corporations to own assets. If you look at the same period of time, they deregulated so that John Lewis, pension funds, the banks, Lloyd's, the company you go and put your 20 quid in or 500 pound in, or you use as your current account, they are owning multiple houses now, and a lot, almost like millions of private landlords have exited the private rental sector since 2017 because of this issue of taxation caused by something called Section 24 in the tax laws. So that's why we go back to the principle of this video is about how do you own assets at the moment, and you should be owning it. And if you're buying properties from today onwards, you really need to be in a limited company structure, because you can then deduct, or not you do, your limited company can deduct the interest only part of the mortgage against your rent, and then you pay corporation tax, which is even lower than your personal tax after that. That's how it's been now structured, so that people own assets in terms of this video was talking about, well, what's the article in the NRA talking about, who gets investigated, and HMRC, and etc. etc. So the principle is basically, if you own asset in your personal name and then incorporated it into a limited company, HMRC, and that's never been any different. HMRC and the advice you should have been given at the time, or if you're thinking about doing this, you need to show that you're actually trading as a limited company when you start to migrate from a personal name, LLP, and then limited company. And that principle to show that you're actually working in the company, for you to be allowed to move from personal name into a limited company, the notional amount of working hours in that business is roughly around 20 hours a week in that business. And that was done by case law, that somebody was managing a HMO and proved that he or she was spending 20 hours a week on average on that business. And that's really where that number of 20 hours a week comes from. But in essence, for you and I, what you need to know is, if you're migrating properties from personal name into a limited company structure, because of all the reasons I've given you at the start of this video, you really need to be in and understand how you ensure that if HMRC comes knocking on your door, you can show them that actually it is costing me or you 20 hours a week. And 20 hours sounds a lot, but it's 3 hours a day on average that you will be spending managing your property business. And when you think about dealing with agents, dealing with plumbers, dealing with tenants, organizing ASTs, advertising, there is so much stuff. And let me know if you want me to put a video around, and put it in the comment below that you want a video about all the things that you can show that you do as a property owner in a limited company to cover your 20 hours a week. And we'll compute together a list that, quite frankly, and if you are one of them that are watching this video, put your information about what you do and what constitutes your working week as a property investor. That will then cover 20 hours, because that will help everybody in the community. Make sure that if the HMRC comes knocking, you've got a way of showing, actually, it is not made up, it is costing me that amount of time. If you continue investing, looking for properties, going on viewings, there's so much stuff that we do that we don't account for, or don't realize how many hours it takes. So, in a nutshell, I wouldn't worry too much about this. The other thing to say about this HMRC letter, I was told recently by a tax advisor that that's quite a box standard letter that comes out roughly around April time every year, that goes out to businesses, and this time it was just to landlords, that the HMRC is casting a wide net to try and capture some people. And quite frankly, you're going to get people who own one's house and doesn't do anything with it, and they're going to be shown that actually this is not a business, this is an investment, and actually you are doing this to avoid tax rather than actually trading as a property investment business. So, and invariably we'll hear about those few people that have been caught and done by taxes. There's other things that you will hear. There was some, and I won't mention the name, but it was something to do with landlord and tax. There was a company that was set up to advise, in my opinion, and obviously as it turned out, and I went to their Houston office, very fancy Houston office, lots of whiteboards, lots of complex web. They were showing me about how we could move here, there, move this structure, that structure. And quite frankly, I sat there thinking, if I had to design a tax evasion scheme, that's what it might look like. And that was 7 years ago. And last year, if you know what I'm talking about, you will know that last year they got investigated by the HMRC and found that their schemes were, quite frankly, for want of a better word, illegal and tax evasive, and they got shut down. And their clients have now fallen foul and are being investigated. So not only have the clients have paid tens of thousands of pounds for these tax advice, and now they've been investigated by HMRC potentially to pay even more tax. So I'm gutted for these people. So quite frankly, the test is always if it smells like and it feels like, it is. You know, if it's too good to be true, it probably is. All of these kind of sayings ring true here when it comes to these tax planning advice or schemes that have been going around. So you know this it was called something to do with landlord and tax and savings. So very fancy, very all over social media, but now no more. And it's been culled by the HMRC. It's been investigated and shut down, and their clients have been investigated. So please don't do that. Get yourself some decent property tax advice, and use your own nose. Smell a rat when there is a rat. You know, I did quite a lot of due diligence and eventually found one company now. We've been working with them for 12, maybe even more than that now. And they were the ones that actually helped us through this process. So just to summarize and finish this video here, this is about taxation, how you structure your company, and also if you've got a legacy company, how should you go about doing it. The key here is if you are buying new properties from today, buy a limited company structure. If you've got legacy company, property companies, please speak to, do your due diligence. I communicated, and that's how I came across those tax, save, landlord tax or whatever schemes. I actually physically went to meet at least 10 suppliers at that time, and then eventually met and settled on one that I felt was the most appropriate solution. So same thing for you. If you're thinking about it this way, do it, but do your due diligence as to who you're using. And that's where I would say, you know, if you've got if you're going down that route, also please from now on make a note of every week what you're doing on your property business, how long it's taking per hours, and keep a log on this, because if it comes to it, you've got that to fall back on. You've got dates, you've got activity, you've got hours that you can show the HMRC of what you've been doing. So on that note, my name is Azid. I've been investing for the last 25 years. As some of you might know me already. I specialize in a title split strategy, and I teach people how to buy multiple unit freehold blocks and carve them up, add 25% value out of them, so that I can teach you how to recycle all your cash out. I offer two real courses. One is a one-to-one with me on a one-to-one, and that lasts 12 months, and I teach you and I literally handhold you through the process of how to find these blocks. So stop buying one house, stop buying a HMO, because quite frankly they do not work. The money that you make is not life-changing, I guess, and or you'll need 15, 20 of them, and if the average deposit is 100 grand, you need a 1 million, 1.5 million to get into this game. So don't do that. Either come to my one-to-one with me for 12 months, or come at my next 2-day course, which is the 28th, 29th of June 2024, and I'll teach you how to structure the actual company. And I'll bring the most important thing in my course is not just the knowledge and the content I give you, but it's the contacts that I will connect you with. We're talking about tax today. I'm going to connect you with the property tax advisor that I use, and there's no money exchange here. It is me telling you who I use and you deciding whether you use them yourself. The same thing with the lawyers, the broker, the bridging finance. I teach you how to do it. I show you where to find these blocks of flats, how to carve them up, what legal advice you need, what team to use, and then I basically teach you how to fish, and then you go fishing, and the pond is full of fish if you know what you're looking for. So click the link below, go to my website www.quidditygroup.co.uk, the link's in the bio as well. Send me a DM somewhere, somehow, connect to me, and I'll show you how to make money in 2024, because quite frankly, buying one house, a single dwelling, leaving 25% deposit in is not the way forward. I will teach you how to recycle that cash out, so you can use the same capital you've got. If you've got 100 grand, we can keep using the same 100 grand over and over again, and that is the game changer here. So I'll see you in the next video.